Welcome to the Financial Freedom Show with your host, Brian Connors, a certified financial planner and investment advisor representative with NPB Financial Group, LLC in Irvine. We're all going to arrive at our retirement years, but the question becomes, do you have a plan once you get there? Stay tuned as Brian will help you navigate the important financial matters that you need to be aware of when it comes to your retirement. For example, not outliving your money, protecting your wealth, investment strategies used by financial gurus to create wealth, reducing taxes, and protecting and caring for your loved ones. So pull up a chair and join Brian for this informative discussion.
Welcome to the Financial Freedom Show, the only show that helps set you financially free. Thank you for joining us. I am Brian Connors, your host, and a certified financial planner and an investment advisor representative with NPB Financial Group. Our topic today is strategies for achieving higher returns with less risk. You, like many investors, may be looking for more effective ways to save enough to buy a new home, to eventually retire, or perhaps to pay for your children's college education. Many of us work very hard for the things we care about. For many, saving and investing can be a challenging and requires disciplined commitment. So, avoiding making a big financial mistake and reducing the risk of losing your financial nest egg and hard-earned money is very important to you. Some of you may have experienced the effects of recent market meltdowns, including two of the worst in the last 15 years. The 2000 to 2003 dot-com bubble meltdown and the more recent 2000 to 2009 Great Recession. So the goal of this presentation is to share a compilation of investment wisdom from some of the greatest investment gurus and academic research to help you more effectively achieve your goals with less risk to your financial nest egg. Depending on your investment experience, some strategies may be more effective in helping you achieve your goals, but do not be dissuaded. A qualified, competent financial investment professional should be able to help you using the strategies discussed here to help you build a financial investment plan to attain your financial goals with less risk. So let's begin. To start, what is the number one rule of financial investing? Well, as said by the famous investor himself, probably one of the greatest of all time, Warren Buffett, the number one rule of investing is don't lose money. And so for many of us, how do you do that? And if so, what do you do? And if we do that, what would be the number two rule of investing? The number two rule of investing is never forget rule number one. And that was also stated by Warren Buffett, the greatest investor perhaps of all time. So how do we do that, and how do we get our goals, and how do we accomplish our objectives is what we're going to talk about, and hopefully through the process avoid losing our financial nest egg. So what is lost? Loss is, there's two forms of loss. One is realized loss and one is unrealized loss. Unrealized loss is a temporary loss, whereas realized loss is permanent loss. And so what's the difference? Well, in unrealized loss, we basically have a temporary condition or market situation where money has fluctuated in our accounts that might reflect a lower valuation than our original investment. In this case, that could be due to a number of reasons. It could be due to the fact that it would be related to market economic conditions. The markets, as you know, fluctuate every day. So when we invest today and what actually the value of that asset might be tomorrow could be completely different. But that does not mean that we've suffered a permanent loss. It's just it's reflected on our accounts, and we call that an unrealized gain or loss. Realized losses, on the other hand, are permanent. That is the difference between what we purchased our investment for, which is called the acquisition cost, plus any additions to that investment over time, and may or not include dividends and capital gains that are also reinvested as part of, say, a mutual fund strategy, less what we sell the asset for, and that's the net sales proceeds. And so the difference between those the acquisition cost and the reinvested gains and losses is what we call the acquisition total cost, less the net sales proceeds is what we call realized gains. And why is that important? Well, it gives us to know what our goals and objectives are. And once we step out of the box of guaranteed fixed investments, we are always going to have some component of potentially unrealized losses as well as realized gains and losses. But what's more important here is to focus on what happens during the course of our span of investment. And that is what we call is portfolio volatility. And portfolio volatility is a function of price variance. It's basically what is the deviation of the asset over time around what we'd call a mean. And in building a portfolio, it's important to know what is the expected portfolio volatility. And that's where we get into the nuance of investing and portfolio strategy design. What's also relevant to this discussion is that portfolio volatility can be very unsettling for many people, of course, because no one wants to lose money. And that was the number one rule that we talked about, was avoiding loss of money. But we don't really suffer permanent loss until we actually make the final sales transaction on our investment. But during that course, we will have fluctuations on the asset price in our portfolio as well as our overall portfolio. So what we try to do in investment strategy and portfolio design is to construct a portfolio that minimizes portfolio volatility based upon what the goals of the portfolio are in the first place. Also relevant to that is what we see in terms of fluctuation on the market averages, which we talk about the large major industrial averages, including the Dow Jones Industrial Average, the Standard & Poor's 500 Index, and the NASDAQ exchange averages is different than what we might see and experience in our own individual portfolio. And oftentimes, based upon the composition of an individual's portfolio, we could see volatility a bit more than what we might see by the national averages. And this could be a problem for people that are investing on a long-term basis and how to help them stick to their plan during very volatile market conditions. And so we'll talk about that in terms of how to minimize that portfolio volatility in this discussion. The third area in loss is called market drawdown. And of all the conditions that we're worried about most is what we call market drawdown. Market drawdown is a decline from the peak of the market or your portfolio to the lowest point in terms of the trough of the portfolio in terms of valuation. And now this is a condition that could be a problem in terms of how we deal with that during a market drawdown. We've seen that in numerous times, and most recently in two of the worst cases in the 2000 period, as well as in the late 2008-2009 period, where market drawdowns were in excess of 40 and in many cases 50%. So what that does, that causes a condition that could be a significant problem for a long-term investor to maintain emotional temperament to go through that particular period to attain their long-term goals and objectives. And it's also involving how do we structure portfolios that minimize market drawdown, which we'll discuss further in this presentation. A third area of risk that is talked about by some of the biggest and best investment market gurus of investing of all time, those include names like Benjamin Graham as well as Warren Buffett, is managing our emotional behavior. And over time, emotional behavior may contribute more to the success or failure of any investment strategy than actually the specifics of the portfolio itself. And there are some interesting studies that have been done on why and what has actually happened that basically shares why this is such an important consideration in terms of how we deal with market volatility and why it's important to know how we're going to deal with that beforehand so we don't make bad decisions when it eventually does occur. There was a study by Fidelity Investments conducted on the performance of its flagship Magellan mutual fund during the tenure of a famous manager, Peter Lynch. And Peter Lynch ran the Fidelity Magellan Fund from 1977 to 1990, and he delivered an astonishing 29% average annual return during his tenure. Despite his remarkable performance while running the fund, Fidelity found that the average investor actually lost money during his 13-year tenure. Well, how could that be? Well, what usually happens in this situation is a concept called performance chasing. And that is where investors chase performance during periods of good times, but sell out during times when the market changes or has a correction. And often, in this case, the investor buys at the high and sells at the low. Now, this is not only an instance that happened particularly with the Fidelity Magellan Fund. We could look at almost any broad strategy or investment strategy that might be invested in the more major market averages, including the Standard & Poor's 500. There was another study done by Dalbar from 1985 to 2005, where they studied the Standard & Poor's 500 index as a measure of the 500 largest publicly traded companies. And it returned during that period, 1985 to 2005, 13.2% annually, while the average stock mutual fund investor only earned 3.7% over the same period of time. So here again, we see that investors are often their worst enemy. That difference in terms of the performance of an investment in the Standard & Poor's 500 that generated 13.2% from 1985 to 2005, and as for the investor only earning 3.7%, was significant. It was an astonishingly large amount. If an investor had invested $100,000 in 1985 and earned the returns of the Standard & Poor's 500 during the 20-year period, the average investor would have made $1,193,791. If they had only earned 3.7%, they would have made only $206,811, an astonishing $986,000 difference. So, what do we do to minimize that? There's a couple of strategies and things that people need to consider about their emotional temperament and how they will invest over time to stay the course. One of the conditions that we could talk about that affects investment performance is attitude. It is a tendency for many investors to have overconfidence in their abilities, which is why many investors or gurus suggest diversification and other strategies that limit investor involvement in individual security selection. And so managing our abilities and knowing our weaknesses and controlling confidence or overconfidence is important to being successful in the long term in investing. There are also biases that are important. Some of those biases or examples are narrow framing, using recent market performance information, such as it occurred in the 2008-2009 period, where investors had usually had outsized gains returns in the real estate market and unknowingly put themselves more at risk in terms of investments in their homes, investment rental properties, but also into the stock market. Performance chasing, again, backward looking and trying to find investments that have performed well over the last 2 years and trying to invest in those investments as opposed to looking for investments that may be more value and are beaten down that might have more opportunity going forward. Another condition is what we call asymmetrical loss aversion. That is the condition where an investor has 2 times more pain and agony with suffering from a dollar loss than the gratification that they might gain from a dollar gain. Understanding how investors respond to loss is important, and also how you might respond to a dollar lost or any reduction in the value of your investments in a span of time. Investors also have trouble with perceptions, in particular with mathematical probabilities, as understanding what loss is and the probabilities of regaining that loss is a problem for many investors. We can all relate to the idea of gambling or going to Las Vegas and winning and losing on the gambling table. And that relates to that if we are losing money, the tendency is for us to want to stay the course, even though statistically the probabilities, as we know, are against us. It's also trying to invest a little bit with the hope that we will actually maximize a huge gain but have a very low probability. And in investing, that could be a prescription for very bad results by trying to either what we call performance chase or trying to get too much return in too little time instead of trying to build wealth over time. Another element of investment and behavior is knowing our investment knowledge, and the last one is also our experience. All these can contribute to the long-term success or failure of any investment strategy, regardless of the investment strategy, if it's a good one or a bad one. So keeping that in mind in terms of how you relate to your own personal risk tolerance and emotional behavior in terms of whatever strategy you embark on is important. So let's take a look at what is loss and what it would take, what kind of return it would take to recover from loss. We can see on the chart that a 5% loss or drawdown would only take a 5.3% gain to capture back our loss, which is achievable for most people. We go to 10%, it would only require 11.1% rate of return to recoup our 10% loss. But when we look down further on the chart, we see that a 40% loss requires a 66.7% return to get back our money. And it gets even worse. And when we go to 50% loss, it takes 100% return to get back a 50% loss. This is very important in understanding how that relates to what we call a market drawdown. As we said earlier, a market drawdown is a market that drops from a peak to a low over time, and usually this occurs very quickly, traditionally in the major market drawdowns, as you can see on this chart, starting with 1929 and the last one, number 10, July 1998, the last one on this particular chart. These were some of the more major drawdowns that occurred. As you know, in the 1929 timeframe, the market drawdown was almost 90%. A 90% drawdown would require a 900% rate of return to recoup a loss. So can it happen? Yes. Will it happen again? We don't know. But we do have, in the last 15 years, 2 market drawdowns that were pretty significant, 50%. One was in, obviously, the dot-com bubble in 2000 to 2003, and then also in the Great Recession in 2008 to 2009. What is significant about knowing this is that how can we prevent a market drawdown that could wipe you out or cause significant financial harm that you might not be able to recover, particularly in retirement. What's also important to know is the amount of time a market drawdown may take to recover. And this is important because, as we said earlier, emotional temperament and behavior is critical to the long-term success of any financial portfolio, an investment portfolio over time, more so than maybe sometimes the individual strategy. As we can see on this chart, the time for the recovery can be pretty significant till the time that the market recovers from the original drawdown. If we look back in the 1929 Great Depression drawdown that only occurred in about a total of 3 years, from September 1929 to July 1932, the recovery from trough to peak took 22.38 years. That is a very long time for most people, particularly when we look at retirement. That might not be possible to do if we retire, say at age 60, knowing that we have to live 30 years, we may never get back to even in that span of time. So we also take a look further down, and we've seen some pretty notable drawdowns, like the 1987 market crash, which was significant. That was a 36% drawdown. The recovery on that was not that bad. The total peak to trough to peak years was a total of 2 years. Not that bad. So most people really didn't at the time feel the pain as much as the drawdown actually occurred. So, but if we look at other drawdowns, they have been more longer term. And so, you know, the one that just recently occurred, the 2008 to 2009 Great Recession, many investors are still reeling from the effects of that. So we want to consider that in our investment strategy and planning to how do we most avoid a drawdown and capture most of an up market so that your portfolio will have less volatility and your portfolio performance will be ahead compared to maybe just a buy and hold strategy. And that's what we hope to talk about in the presentation ahead. So let's give an example of what drawdown actually looks like in terms of how that might affect your portfolio in a diversified way, and what the problems with just having the same asset classes or stocks and bonds only in your portfolio, what that could look like in terms of a market drawdown experience. If we take a look at the drawdown that occurred between 2007 and 2009, we see that an investor that had invested in 10 different asset classes, including large cap stocks, bonds, US bonds, international bonds, etc., which many would think would be a diversified portfolio. The actual experience of an investment portfolio that had diversified across these 10 different asset classes, 10% in each, the investor would have actually experienced a 40% drawdown over the 16-month period. So how does that happen? And why is that a problem? Well, conventional wisdom by many investment professionals is diversification is just enough to do across different asset classes to be successful on any investment strategy. And as we see here, that's not true. If you had had a buy and hold strategy, including these 10 investment asset classes during the period of 2007 to 2009, you would experience 40% decline in your portfolio. Many people can't tolerate that, and in fact, many people today are still reeling and recovering from that prior experience. Particularly as this relates to retirement, many investors don't have enough time to recover, like we talked about earlier, if it's going to take 10 or more years for the portfolio to recoup its losses. So what we want to talk about going forward is how do we generate smoother rates of returns with less risk. There are 5 areas that we can look at to try to do investment diversification and investing in other kind of non-correlated assets, alternate investments, portfolio optimization, portfolio risk reduction strategies that can help us achieve smoother market returns in our portfolio with less risk. So let's talk about each of these and discuss how they can be useful in terms of minimizing portfolio volatility during the period that we're investing so we have a better chance of achieving our goals and being more successful. The first one is diversification, and as we can see from the chart, there is diversification that could have lower risk, and there is non-diversification that has higher risk but higher return. It's that yin and yang of more return, more risk, or less return and less risk. So if we invest, like an example, in the entire market, the diversification helps us leverage our efficiencies across a very large number of investments, including potentially other non-correlated investments, maybe the difference between investing solely in US stocks, but also including international stocks. So diversifying in multiple investments in a particular fund or pooled investment can reduce our overall risk through the process of diversification. If we go up one, we see just investing in one market, say the US market only, we increase our risk of potential volatility because whatever happens in the US is one scenario. What happens internationally could generate particularly different types of performance based upon the current economic and market environment. Investing in one industry increases our risk, but also our chance for more return. So it's important to diversify across multiple industry sectors to minimize our potential variance in our portfolio. Individual stocks, while they can generate the highest return, have the highest risk. So yes, we all hear about the investor or the business owner that made a fortune in their one company stock. But we also know about a few times in previous years here recently, like Enron, WorldCom, where the investors have actually not only lost money, but actually went bankrupt. And so our goal here today is to try to talk about ways that you can be successful and earn a decent return to achieve your goals and objectives. One of the strategies not quite readily understood is how do we use non-correlation in our investment strategy? Succinctly, non-correlation is essentially investing in assets that interact and do different things in different periods of time. And so the simplest way to understand correlation is something that's totally correlated, which we would consider given a ranking of 1, to something that's totally negatively correlated, which does just the opposite, which would be -1. So if one investment went up $100 and the other investment, which would be negatively correlated 100%, would be you would lose $100. That's not what we're trying to do, is earn 0, but we're trying to mix asset classes that, if we do it appropriately, will minimize and smooth the fluctuations between our performance over time. And so what we tried to do is mix in different asset classes, as you can see on this chart. Say US large stocks have a correlation of 1. Global fixed income relative to US large stocks or neutral stocks, blended stock, a blended portfolio like the Standard & Poor's 500, global fixed income has a negative correlation varying between -0.5 and -0.25. And it's the intermixing of those asset classes with diversification which can help us minimize some of the portfolio volatility to reduce our risk while we're investing over time. Another strategy for also reducing risk is including in our diversification alternative investments. Alternative investments have low correlation to traditional stocks and bonds and cash. And so what are those kind of investments? Well, real estate investment trust is one example. Oil and gas investments, art, collectibles, precious metals, and then certain types of hedging strategies which are not directly exposed 100% to traditional stocks, bonds, and cash assets. By intermixing these various different alternative investments into our diversification process, we can reduce correlation to increase performance and reduce risk over time. What's interesting about this is that most people do not understand that some of the largest endowments have a large investment in alternative investments, while the average investor has a very low investment proportion or allocation to their investment portfolio. The largest endowments have an average allocation of over 59% allocated to alternative investments. For most of us, this may be way too much based upon our investment knowledge and experience. But it does suggest that large endowments, which are managed by some of the smartest minds on Wall Street, are doing this for a reason to reduce their risk, because their payouts typically are going to be over long periods of time, and this money is used to fuel the investment in the education resources of the institutions involved. So the average investor has a similar scenario, particularly as it relates to retirement. Retirement for many is typically a 20 to 30 year period. And trying to reduce the chance of loss and smooth returns and more predictable returns is a very strategic objective, particularly in retirement planning. So incorporating alternative investments into your strategy can help you achieve long-term better performance results, but also minimize risk during the time period you're investing. Another strategy to incorporate into your diversification and strategic strategy of investing is a concept called portfolio optimization. Portfolio optimization evolved out of modern portfolio theory, which was fathered by Harry Markowitz in the 1950s. Using portfolio optimization, it's a process to reduce portfolio risk over time and achieve better performance in the long run. And it's the strategy of how we mix asset classes based upon a certain risk profile, whether more conservative for low risk to more aggressive in terms of high risk but high return. And it's the allocation of assets based upon a portfolio optimized strategy that can lead to superior performance over time. Investors that do not apply portfolio optimization might find an inefficient portfolio, such as in the chart, where they're actually taking on more risk with less chance for return. And so incorporating portfolio optimization into your investment process can lead to longer term performance results with less risk. The last strategy we'll discuss to include in your investment strategy for increasing performance and higher returns with less risk is using risk reduction strategies. These strategies have less to do with the investments themselves and more to do with the trading strategy of how we invest our money over time and what we do to reduce risk as well as reduce loss. The ones we're showing here are, one, buy-sell discipline. Having a buy-sell discipline can help us know what investments we will buy based upon certain market, economic, and investment conditions, and also having a sell discipline as to when do we rebalance, sell, or stop loss in a scenario where there might be a market drawdown occurring. Having a sell discipline is very important. While most investors have a strong buy discipline in terms of doing their research to figure out which investments they might own, many do not actually think in terms of what discipline are they going to use to sell or reduce allocation to investments that might be underperforming or experience a major drawdown. One example of this is having a stop loss type of program in place. There are multiple ways to do this. Some are using some certain trading strategies, including stop loss orders. Others can use some hedging strategies, which include options and future contracts to try to reduce risk in terms of the overall portfolio during market volatility periods. Another area is also looking at an individual stock selection, particularly the business risks, and understanding what is the underlying business return drivers that will lead to long-term performance in investments, and what business risks might be involved in individual stock selection that might over time be significant, and actually it may in fact incur large losses based upon those risks. The last is mitigating market tail risks. Market tail risks are those unforeseen event risks that no one can predict that can derail a portfolio, in many cases potentially wipe out a portfolio. And event tail risks typically occur during market drawdown periods. These are the types of things that we want to try to avoid or put a strategy in place to help us reduce the event tail risk conditions that might sabotage our investment portfolio. So what are some strategies that we can use to minimize tail risk, drawdowns, and minimize portfolio volatility? The strategy shown here shows that there's some strategies, trading strategies that we can do to, when we will invest in a particular investment or strategy on the buy side, and when we will cut our losses if the events turn out to go wrong and actually reverse themselves, and then when we will take a profit and or maybe rebalance or reallocate our positions. These are strategies that you can incorporate into your retirement and as well as into your investment strategy for any kind of purpose to try to achieve more return on the upside, but most importantly, protect your investment portfolio against a market drawdown. And we suggest considering these strategies. There are multiple versions of this depending upon how they are implemented. Everything from hedge strategies, or including alternative investment strategies of other kinds, but also including maybe use of puts and call strategies that can help you reduce risk to protect your portfolio. Another version of this is showing how an investor might sacrifice a little bit of their upside, but can protect against the downside to protect their portfolio. So this increases the chances that you will be successful, but sacrificing a little bit of the return. On the other side, it reduces a chance of a major drawdown that might occur in your portfolio. Another strategy for helping be successful over time is knowing what the difference between what is passive investing and active investing. Passive investing includes using things like index asset classes, while active investing uses active management. An example of this would be using index mutual funds versus using actively managed mutual funds. Over time, the cost involved in an actively mutual fund can be more expensive. The advantages of that might be managers have a chance to do certain things during certain conditions, particularly as it relates to tax planning, and in certain markets where active management might be more successful, where performances are not so correlated, particularly to the major averages, and that where individual security selection might be relatively more important. Index investing is one, generally benefit is lower fees and expenses. They also have the ability to diversify across many different kind of assets to reduce risks. Broad market exposure using typical index funds and some of the major averages reduces the risk of any individual security or exposure to an over allocation to one security that might compromise the investment itself. They come in both mutual funds and as well as exchange-traded funds. And yes, they can be used in search hedge strategies to reduce risk. Active investing is based upon the concept that the markets are inefficient and that over time, an active manager can find what we call alpha in terms of additional incremental return for the risk by security selection. So which is better? I guess the question comes down to what is your strategy, what are your goals, and whether or not an active manager could add some additional diversification to increase overall portfolio performance with less risk. On a larger scale, active management has generally not outperformed index strategies such as index mutual funds. So the general consensus on most investment management type of professionals is passive index asset management is got some benefits and maybe some advantages to active management, and it's considering that in your investment strategy is important. Let's talk about some investment styles that also can add some additional diversification to your strategy. There are two major investment styles that are used in the marketplace. One is value investing and the other is growth investing. What is better? It depends. It depends upon a lot of factors, including the current market and economic conditions, whether you would be a value investor or a growth investor. Value has generally over time been considered the better strategy because it basically reduces the amount of risk that on the downside with offering most of the upside in terms of performance. Maybe not in terms of high growth rate companies, but businesses overall can succeed even if they're not very high growth in terms of delivering exceptionally great returns in the long run. What are some of the differences between value investing and growth investing? Value investing tries to invest in low volatility stocks or securities that have what we call a low price earnings ratio, so that they are considered value stocks. The price that you pay to the book value is low. They usually try to have, many of them have dividends because they typically to be more seasoned businesses that are in the past their major growth phase and they're more in the mature phase. They have a chance to increase book value over time by the management of the business in terms of operational management. And they use low cost of capital as best as they can to provide extra performance over the long run in terms of their returns. Value investing is espoused by many famous investors, including some of the greats like Warren Buffett as well as Benjamin Graham. And over time, if you can find investments that have lower beta, lower price earnings ratios, and lower price to book, the performance can over time lead to better results with less risk. Growth investing focuses on more where the business is going. It's in the emerging to growth phase of their particular business where earnings per share growth and revenue growth are in the acceleration phase. What are typical attributes of growth investing? High revenue growth rates. Rate of growth is important. Revenue growth versus earnings growth is more important. It's usually investing in a new market area, which would be a new category, such as internet, computer software. Latest might be in social media as an example. Also in new technologies, perhaps like in wireless and mobile and newer car technologies that we're seeing today in the marketplace. It could be also in new energy. Each industry might have new growth drivers or new drivers in our industry that are leading to outsized growth in terms of particularly the business growth. The analytics that are used particularly to evaluate growth investments are revenue drivers. Revenue generation, sales growth are particularly important in terms of the attributes that a growth investor might be looking for. Customer acquisition, we see that in some of the social media companies today. Gross margins, which are the difference between revenue and the cost of goods sold, is important because it shows the raw operating profitability of the company. And then how scalable is the business to grow into becoming a large company over time, and buying in an early stage of the company's growth phase can lead to outside performance as that company continues to grow and mature. If you're an individual stock investor or looking to generate returns and get outside returns by individual stocks, which we earlier described as potentially more risky, but can offer higher returns. We all know about the famous friend or investor or whatever that has done extremely well because they invested in some particular company or maybe worked for a company that became one of the large companies today, and as a result is made huge returns because of that investment. And some of the reasons and some of the attributes that you might invest in individual stocks are because you're looking for things that can generate outsized returns to you over time. Some of the measures that are used in evaluating these type of companies and what might be useful for you in evaluating any investment in an individual stock particularly would be, does it have a high free cash flow yield? Cash flow is a very difficult term for many people to comprehend, but cash flow has to do with the operating side of the company and how well the operation is managed in terms of generating cash to the business, which could then go into retained earnings and increase book value. Many famous investors really follow cash flow as an important criteria for determining investment. Another metric is return on invested capital. Return on investment capital is a measure of the performance of how well the manager or the executives are managing the deployment of their assets and the capital that they've invested in the company to generate return. It's a very important metric, particularly for savvy investors that are looking to differentiate which investments they might buy versus just looking at, say, earnings per share growth. Another measure is return on equity, is what is the profitability on how much money is being made on the equity of the company. Think about your home or another type of investment that you own. Your actual investment, how much money have you made on that individual investment that you've made to that investment? Higher return on capital, capital employed, is traditionally used in highly intensive capital investment industries, including utilities, telecommunication companies, where typically they have to invest not only the equity, they have to invest or borrow a lot of debt to fuel the growth of the infrastructure. So how is the measure of return on capital employed apply to those type of companies? One metric to decide which might be a good investment would be looking at companies that have a low, what we call enterprise value to free cash flow. And we'll talk about free cash flow in a second. The goal here is to generate higher alpha or return for the risk that we take on individual stocks when we're making our decision which stocks to buy. So looking at these particular types of criteria are very important, potentially to the long-term performance of the investment itself. What is free cash flow? It's such an important term because, again, many investors that have been very successful have used cash flow as their particularly number one metric for determining whether that's an investment they might make. Cash flow is the earnings before interest and taxes plus depreciation and amortization added back in, minus the change in net working capital and minus capital expenditure. This gives you a raw measure of how the operational aspects of the investment are working and the management that is managing the operations to generate cash, which at the end of the day is returned to shareholders either in the form of dividends or reinvested back into the company to earn more cash flow down the road. And if you look at the real successful investors, investors like Warren Buffett and others, their particular metric that they use in terms of determining which companies they might buy are not based on the traditional metrics most investors use, like price to earnings ratio and earnings per share, which could be subject to certain type of accounting gimmicks that might not really tell you about the real operational performance of the company. So looking at free cash flow is important in terms of making an addition in individual investments. One of those metrics that might be useful over time to consider in individual stock performance and investments is looking at free cash flow yield, which is the free cash flow divided by the actual market capitalization, which is the value of the company capitalized what the market is saying it's worth. And if you look at that metric as to whether that's a rising number or a declining number and compare that against other individual stocks you might be considering for your portfolio, you have a better chance of maybe being more successful with a company that has a high free cash flow yield. So if you are inclined to want to invest in individual stocks and want to benefit from some of the wisdom of some of the investment greats, what would be some of the criteria that you may want to consider using in determining what type of businesses or what type of investments or stocks you might want to buy? Well, I put together here a list of the criteria that one famous investor, Warren Buffett, has used in the previous years to generate outsized rate of returns for his portfolio and also minimize the potential risks of an individual business not performing and over time not delivering the performance of investment that you're looking to generate. So what are they? Well, according to Warren Buffett, some of the metrics are wonderful businesses have a good return on capital without a lot of debt. Those are back to the metrics I shared with you earlier, which are return on assets, return on investment capital, return on equity, return on cash flow. Those are metrics that you might consider looking at in terms of which company you might want to invest in. And they also don't have a lot of debt. Debt can be good for leverage, but also brings risk in terms of the potential that the company might have trouble during difficult years on paying back debt, which could lead to losses in terms of earnings, but also significant underperformance and maybe even outright bankruptcy in the individual investment. Another criteria used by wise investors is invest in what you understand. A big problem for many investors over time is that they invest in industries and in investments that they have no market knowledge of the business itself. They might have been in one particular industry during their career and they know that industry very well. What are the performance drivers? But they don't know what the performance drivers are in an industry that they were not involved in, and yet they choose to invest in it and not knowing what could be the market and economic conditions that might cause that business to suffer during a drawdown. An example of that might be the energy business right now, which has experienced a 50% drawdown in the last 6 months. And understanding what are the performance drivers, what are the return drivers of that investment in the first place would have helped maybe alleviate the drawdown that might have occurred, but also maybe going forward be a good indicator of when to invest, because now those investments have fallen so far that they might be value there that an investor could generate outside returns going forward. But knowing what the performance and the return drivers are is very important. Wonderful businesses see their profits in cash flow, as we discussed earlier, not in earnings per share. Knowing the difference is important. Also, wonderful businesses have a strong franchise and therefore freedom to price their product or service at a higher sales price than maybe their competitors. The difference might be a brand name company versus a generic. Another might be a company that has a premium product. You can think of numerous products in the category of consumer brand companies, particularly that we might buy on a day in, day out basis, that we buy their brand just because it is the brand. The name of it speaks highly about the value of that brand, and as such, that carries a higher price than maybe other products that might be of similar quality, but we just trust the brand name of the company. It doesn't take a genius to run. It's easy to understand. The business has very easy to understand performance drivers. The earnings are predictable. In other words, they generally are consistent over different periods and different economic and market conditions. If you can find companies like that, the chances for a bad period, which could lead to a significant drawdown in your investment, you could avoid. And the manager is owner-oriented. In other words, the manager is focused on shareholder return, not executive compensation as a primary driver. Not to say that they can't be both included. It's just that they have as much interest in their performance of the share for the shareholders as they do in generating executive compensation for themselves. So we've talked a lot about different opportunities and strategies for investing your money to achieve your goals, to achieve higher returns, and hopefully to reduce the risk of losing money along the way so that you can enjoy retirement, buy a new home, pay for your children's education. So now it's up to you. And what is your dream? And what does that look like to you in terms of what are you trying to accomplish? Well, to help you in that process, accomplishing your dreams, you might want to consider a process that's been very successful in helping people prepare themselves as well as to create a strategy that they can be successful at. That process is known as the financial planning process. The financial planning process is a comprehensive strategy. It starts with the goals and objectives of what you're trying to accomplish in the first place. Where do you want to go? What is your goal for retirement? What is your goals for your children's education? How much is that going to be? And when is that going to be? What time frame? It then goes to looking at where are you now? You can't take a trip and go from, say, one state to another without knowing where you're starting from to get there in the most efficient and cost-effective way. So like if you were going on a trip, you need to know where you're starting from, and taking an accounting of your financial situation first and where you are today will then help you plan for where you want to go. And you can run calculations to determine how much money and how long that will take to get there based upon different kinds of conditions and rate of return expectations, inflation, etc. Understanding your tax situation. Your tax situation is important because obviously if you lose money due to taxes in your returns, you're going to need more money and more return to get to where you want to go. So taxes can be minimized by certain types of tax strategies as they may relate to retirement planning. For one, there are things called tax deferral, and there are before tax deductions that you can get based upon certain investments that you might make in terms of a defined contribution plan like a 401k plan, an individual retirement account, etc. And there's also ways to minimize taxes on the back end in terms of the sale and how you take that gain or loss. Whether it's a long-term gain or a short-term gain, could be a significant reduction in the amount of taxes paid on that investment. How do you defer taxes over time will also lead to the opportunity for you to make more money during the years when you don't need the money on money that is borrowed from the government until you have to make the payments on the distributions like you would, say, from an individual retirement account. Very important is knowing your risk tolerance. And this is the summary of all the conversations we had earlier about your emotional temperament and your attitudes towards risk and your behaviors during how you will react to certain type of disruptions that might occur, such as market drawdowns. From there, we build a financial investment strategy to attain those goals based upon certain market and economic and investment criteria. And once we do that, then we implement that plan to get started on the journey to our goals and objectives. Along the way, however, a regular monitoring and review process is necessary to understand if we're off course, if we've made a wrong turn, or if there's been a change in strategy, our goals, our objectives, or in the market conditions that might affect our long-term performance. Using a strategy such as the financial planning process can help you achieve your goals more efficiently and effectively, as well as minimize the risk of you losing money. In addition, you might need some help here. So many investors do not have the requisite market knowledge, investment experience, or financial planning background to help make these decisions in the first place. So, working with a qualified professional who can help you do the analysis can help you with that. They can also act as your coach, and they can also help you make the decisions in a better qualified way so that you can be more successful. You know, as many of us know, every great athlete has a coach. As such, so most of us should also have a financial coach, and I'd advise you to consider one. So summing up, in summary, what is your dream? Where are you trying to go, and how are you going to get there? Do you have a plan? And if not, what is your goals to try to get a plan, and how would you go about doing that? Every plan starts with number one, what are your goals? What are your objectives to get there? What is your risk tolerance? Knowing that and being honest with yourself about what amount of risk portfolio volatility and market drawdown and portfolio drawdown you can sustain and live with during those periods so that you can be successful in the long run is important. What is your investment knowledge, skill level, and what is your time commitment to investing in the process so that you can hopefully get to where you want to go financially? No problem if you're not a financial guru. If you're not an investment professional or lack time, you can get a professional to help you in developing the plan, the investment strategy that can include all of the strategies we discussed earlier, including pooled investments, alternative investments, diversified hedging strategies, and strategies to optimize your investment portfolio return and reduce your risk. You can get help in defining your investment strategy as well, and help as well in implementing your investment strategy. But most importantly, you also need to regularly monitor your performance and do that on a regular basis. And if you don't have the time to do it or the investment skill, you can hire a professional to do that, and we advise you to do so. But in ending up and starting it out, the most important thing to do is to take action today and to proceed forward based upon this information, because this is just information. Your financial goals and objectives are in front of you. Taking action today is a starting point to getting to accomplishing those financial goals. Join us next week for another edition of the Financial Freedom Show, heard exclusively on financialfreedomshow.net, or can be downloaded from iTunes and podbeam.com. Are you struggling with a financial problem, needing an independent perspective, but don't know who to ask? The good news is that there are financial professionals who can work alongside with you as a professional confidant and financial advisor to help you frame and then analyze your financial problems correctly, and then provide you financial advice and alternatives to solving your most pressing financial concerns. If you need help planning for retirement and/or post-retirement, managing your financial nest egg, or help getting the necessary coverage to protect you and your family, contact me to get your financial concerns addressed today. My measure for success is your financial security and peace of mind. So don't procrastinate. Take action today. If you are a California resident, there is an answer to your problem. Contact me at 949-271-6433 or email me at bconnors@npbfg.com. Again, 949-271-6433 or email at bconnors@npbfg.com. I'm Brian Connors, and thank you for listening in.
The information in this presentation is not intended to provide tax, legal, insurance, or investment advice. The information, opinions, or recommendations are solely for informational purposes, constitute the participant's best judgment, are only valid as of the date of this presentation, and are subject to change without notice. Investment information in this presentation is not an investment recommendation or solicitation. The participants are not advising you personally, and such information is impersonal and is not tailored to any specific person. You should consult a qualified investment advisor regarding your specific personal financial and investment decisions, and consult an attorney or tax professional regarding your specific legal or tax situation. C. Brian Connors is a certified financial planner and an investment advisor representative with NPB Financial Group, LLC, member FINRA, MSRB, SIPC. He is licensed with the California Department of Insurance number 0661999.